Friday, December 12th, 2025, Maneco 64, home of alternative economics and contrarian views. I've been warning about the crack-up boom or hyperinflation really since 2006 and 7, but on this channel, of course, it's been since the inception of the channel in 2015. And there have been a lot of naysayers who say, and still say, that we're going into a deflationary collapse. We're going to see deflation. Yes, we are seeing deflation of prices in terms of precious metals. That's what we're seeing. But believe me, I think investors had a day to digest what the Fed announced on Wednesday. And it looks like it's QE forever, like Ben Rickert noted in his latest Substack article, and I'm going to refer to it. I'd love to have him on. It's not the real Ben Rickert, it's a nom de plume, but he's very private. So I'm going to go through his article today, and I'm going to put a link to it in the description. I highly recommend his Substack. You might want to subscribe to it. And another thing about Substack, I am on Substack, but I don't really post stuff there or write there. I might do it in the future. The stuff I do here on YouTube is enough for me right now. And so I'm going to refer to this book as well, Fiat Money, Inflation in France, because it has a lot to do with this concept of QE forever. And I'm going to refer to Human Action by Ludwig von Mises, because he was the expert on the crack-up boom or currency collapse and why it comes about. And you probably remember me saying that, taking an excerpt from that book and saying, are we there yet? And I think we're really close. And it's going to be very disruptive for the general public, and even for people who are asset wealthy, that even have hard assets. I'm not saying that hard assets aren't going to do well, but it's going to be a very disruptive economic, social, political, and geopolitical atmosphere, and we can feel it already. We can feel all that, and those, of course, are the symptoms of currency collapse that I've spoken about many times. I even have a playlist, a hyperinflation playlist, which I'll put up here. This video, of course, is going to be included in that playlist. So before we go further, just to let you know, I saw yesterday afternoon, mid-afternoon London to the evening, gold and silver did really well, and I think we're just starting. You've seen this chart many times here, me comparing the price of gold since the let's say late 90s to the price of gold in Reichsmark post-World War I, and they look very similar, and it hasn't changed. It's the chart of currency collapse. Why currency collapse if it's going up? Well, because it's gold going up against the currency. The reverse of that, of course, means that the currency is going down. Do I think we're going to get into the trillions of dollars in the price of gold? I don't think so, but it's going to get a lot higher than we're now. But I think the shape matches the shape from Weimar Germany pretty well. And I've called it a, what was the term I used? I've got it here. A disturbing resemblance, right? And it is really very similar, these two charts. So that's what I think gold and silver were telling us yesterday. And I didn't look very closely at the markets until this morning, because I went out of the couple of old friends from the city of London. I used to work with them at MF Global, and we had a nice lunch and a few drinks afterwards. I got home all right. Have a little bit of a headache because I'm not used to drinking that much, but I'm fine this morning. They're both into the metals as well. One of them I've interviewed recently, Neil Adams. You might remember him. So we had a very good time. Had some steak. There's a place you go. The only thing you can eat is steak. The only choice you have is how you want it cooked, and they give you two servings. So it was very good. I also saw this morning that UK economic statistics have come out. And I saw the headline come up on my phone from the FT because I subscribe to the FT. And it said UK GDP unexpectedly contracts by 0.1 in the month of October. It's funny how they always say that, unexpectedly. Also when CPI rises, they always say this is unexpected. Well, to you and me, probably isn't, right? Because we know what's going on. The government is crowding out the private sector, taxing the private sector. How is GDP going to go up, right? So the year-on-year GDP for October was really bad as well. It was expected to rise to 1.4, but it only rose 1.1%. So this is going to make it even worse for the government. They're going to have problems. And I see that the trade balance, the trade deficit was bigger than expected. It was expected 19 billion pounds. Trade deficit came out at 22.5 billion. So, yeah, I've said many times, of course, that all fiat currencies are sinking, but I think the pound, it's levitating right now. I think we could see the pound go down quite sharply versus the other fiat currencies. That would propel it even higher, of course, versus gold. So that's what's going on. And I think yesterday was like a delayed reaction to what the Federal Reserve did or announced on Wednesday. People realized, as Ben Rickert, the Austrian analyst, said in this article. So let's go through it and then we'll look at the books as well. QE forever, the structural break that guarantees a metals super cycle. And I just wanted to show you a chart before I start. And I've been following this chart. I probably showed it to you already. It's the silver to S&P ratio. And you can see here that, it's been on a downward trend, really, since the early to late 70s. It's like a falling wedge. Yes, it bottomed at the beginning of the century. It topped in 2011, and it had been coming down. It formed a base in the last few years, and now it's breaking out massively. We broke out the high from September 2020. And next up will be this trend line. And I think it's going to break this trend line. And what this is saying is that we're shifting from a world of financialization to a world of hard assets. So I just wanted to show you that. Let's start with the article. A 40 billion Treasury bill purchase program to stabilize money market has been launched. That's the Federal Reserve, effectively expanding the balance sheet and preventing tighter funding conditions. The Federal Reserve didn't just pause tightening, it pivoted toward liquidity expansion, again in ways that closely resemble quantitative easing, or QE, which is money printing, right? Or reserve printing, if you want to be technically correct. Markets know what this means. QE is no longer episodic. It's become quasi-permanent. This structural shift breaks decades of thinking about monetary cycles and lays the groundwork for a precious metals supercycle, particularly in gold and silver, which are behaving as if the Fed is stealth printing, not tapering. Well, I'll bring up this book right now because he talks about QE forever, and this book has taught me so much. I read it over 20 years ago, and it's about revolutionary France in the 1790s, how they tried this experiment with the assignats, printing money. Actually, that was backed by something in the beginning, church lands and stuff like that. Confiscated property from the aristocracy, and it was supposed to be one issue of assignats, or paper money as it was called, because it wasn't real gold and silver, and the National Assembly was very skeptical about it because they saw this kind of experiment fail with John Law in the 1720s. So they said, we're only going to do one issue. But they ended up doing many issues, and the assignats, by 1796, they tried something else called the mandat territoriaux. All these two failed massively. They collapsed, right? It was a currency collapse. They had hyperinflation. So the lesson from this book is that once you go down this road, like we did, in 0809 of money printing, it's impossible to stop. And that's what Ben Rickert is saying. So let's continue here. What QE forever really means. Officially, the Fed says the Treasury bill purchases are a technical response to repo market strains, not a return to broad asset purchases, but markets don't price labels. They price outcomes, reserve growth, dovish rate cuts, yield curve compression, currency pressure, asset price repricing. That's QE in effect, even if not in name. Since rate cuts and balance sheet shifts have historically boosted precious metals, the current environment reads like a structural regime change, not a cyclical adjustment. Precious metals respond like it's QE. Gold and silver have responded with classic QE era behavior. Gold retested multi-line highs near 4,300. Even as Fed signals wobbled, silver surged above 63, a record that far outpaces most commodities. These aren't random spikes. They're price movements consistent with falling real yields, weakening dollar, abundant liquidity, inflationary expectations. QE, whether overt or stealth, creates fertile conditions for non-yielding stores of value. I'm going to stop right here. I think this is good enough, and you can read the rest and subscribe to the Austrian analyst, as he calls himself, Ben Rickert. And I think that chart of silver that I showed you versus the S&P is telling us that this fertile condition is there for non-yielding stores of value, i.e. hard assets. Let's quickly go through a passage here that I've gone through many times before from Human Action, from Ludwig von Mises. It's from page 428. And I still have, are we there yet? I think we're pretty much there. But until it really happens, and I think it's happening, I will take that off eventually because we will be there. So this is what von Mises says. But then finally the masses wake up. I think the big investors, the smart money, they see it coming. They're the ones buying physical gold and silver hand over fist. The masses haven't woken up yet. But they become suddenly aware of the fact that inflation is a deliberate policy and will go on endlessly QE forever. A breakdown occurs, the crack up boom appears. Everybody is anxious to swap his money against real goods. No matter whether he needs them or not, no matter how much money he has to pay for them. Within a very short time, within a few weeks or even days, the things which were used as money are no longer used as media of exchange. Well, think fiat currency, right? They become scrap paper or scrap digital entries. I put that one there. Nobody wants to give anything away against them. It was this that happened with the continental currency in America in 1781, with the French mandat territoriaux in 1796, and the assignats as well, I would add, and with the German mark in 1923. It will happen again when the same conditions appear. If a thing has to be used as a medium of exchange, public opinion must not believe that the quantity of this thing will increase beyond all bounds. Inflation is a policy that cannot last. So, yeah, I think if we're not in it already, we're very close to this crack-up boom. Another symptom of the crack-up boom is the stock market going up, and we're seeing that. The problem is that in terms of the real money, gold and silver, the stock market is not doing well, as you saw by that silver to S&P chart, and you can see by many other charts. So I think that's where we are. And this morning, it's 10 to 8 a.m. London time. So gold and silver continue to move up. Spot gold is at 42.88. The high's been 42.90. If you remember, the all-time high is around 43.80. That was mid-October. I think we're going to break through there eventually. Could be very soon, could be before the end of the year. Silver, of course, is doing really well. It's up 20 cents at 63.77. It traded up to 63.97 overnight. That's the spot price, almost 64. The NASDAQ 100, I saw it didn't do very well yesterday because of Oracle, I think, and it's still down 34 overnight. The Dow, though, is making new all-time highs. S&P is very close to it. Right now, the currencies are fairly quiet. And I noticed that bond yields are still really sticky, still fairly elevated, not just in Japan, but also in the US. So with that, I'm going to wish you all a very good day. Take care. Bye.